kudos to emerging markets. They've actually demonstrated a lot of resilience after some pretty tough knocks, including the pandemic, including the energy crisis that we saw. And if we have to take a lesson away from it, the reason that they had that resilience was they built up good, solid monetary policy frameworks. The inflation targeting regime, maintaining that credibility and the commitment to it in an uncertain environment will firstly require also proper communication, which I think can become a challenge in this environment. I'm curious to know how Raghu thinks about this. How do you communicate as a central banker in an emerging market? Because on one hand, you're still in the process, several are still in the process of building credibility, and talking too much can create a lot of confusion and not really help. But on the other hand, when you're in this environment when there's so much uncertainty, how do you convey that you are sticking to your mandate and you are sticking to the goals of monetary policy? So focusing on sound communication, on committing to inflation targeting, on anchoring long-term inflation expectations, that's going to be very critical. And I'd love to hear some responses to some of the questions I asked.
Well, just on the independence, I think no set of laws can protect a central bank when society turns against it. I think this is Lesseche's point. Your independence comes from the constituencies who believe you perform a vital function. And it need not be the head of state, but it can be bond market players, it can be banks, it can be the broader public, which likes a regime of low inflation, and you've convinced them that you're central to that aspect. So I think to Gita's last point, part of your communication is to indicate that this is an important function. And you're trying to go beyond the set of analysts who follow you very carefully to the broader public and say, look, we are providing a function which is important. There is a reason we just don't reduce interest rates, because it can affect you in so many ways through the currency, through longer term inflation, et cetera.
Which tools to use, and whether there are some tools that are becoming in central bankers' toolkits that are becoming more, I want to say, fraught, simply because of their frequent use. And Dr. Rajan, I'd love to start with you. This idea of controlling capital flows, the idea of foreign exchange intervention, the idea of tools that have been used for a long time. Does it become riskier to use them in a moment like this with a lot of shocks, or does it become necessary?
Look, I think when you look at it from the perspective of emerging markets, the movement in foreign exchange rates are much more sensitive to shocks than in industrial countries. And those movements can have feedback effects. In India, for example, everybody watches the dollar-rupee rate. Not the real effective exchange rate or the nominal, it's the dollar-rupee rate. A lot of middle-class parents have their kids in the US. That affects the funding of those things. It becomes a very central sort of number. And so if that starts collapsing, questions are raised in Parliament. Why is the rupee depreciating so much against the dollar? And it becomes a source potentially of some kinds of panic. So broadly speaking, I think the Reserve Bank has focused on reducing volatility in that rate without saying this is the level. That's very dangerous. You don't want to defend any level. But you want to reduce the speed of reaction to anything. And in that process, you may build up reserves, you may sell reserves. It's not unidirectional. And the way you explain it to the global audience is we're not targeting rate. We don't use this as a comparative tool. This is more a precautionary tool to reduce the volatility, but also in the process sometimes to build up reserves so that we can have a way to reduce that fluctuation. Higher reserves also build more confidence that you have the capacity to intervene if necessary. What is important is, of course, to be judicious in that intervention. And, some of us fail, some of us succeed in that. But I think broadly it's a tool you don't want to let go. You do want to use it.
Governor Kanyago, you were nodding when you said that you want to mitigate some of the huge swings.
Given the world that we're in, and given the numerous shocks that we have faced, and while we can all hope for a more predictable, less shock-prone world, I think it's a good idea to firm up your policy frameworks and your toolkits for a much more volatile world. For an emerging market central banker, they are grappling with much more difficult trade-offs than a typical advanced economy central banker has to deal with. And the exchange rate is a variable that is pretty unique to the kinds of challenges that central banks have to face with. So it's, you're concerned about whether you can get your price stability mandate working and your financial stability going at the same time as your exchange rate is depreciating, and how do you manage those trade-offs? I think what we have learned from the last few years, from the vast experience of the many emerging markets that we work with, one, it helps absolutely if you have a very clear monetary policy framework, and if you rely on your policy rate as the main tool for doing monetary policy. I think that remains the case. So while you do have these additional tools in your toolbox, you don't want to keep using it multiple times because it can be terribly confusing. So the policy rate remains the main tool for doing monetary policy. Now, there are going to be times when you want to use other kinds of instruments. And then being able to explain exactly why you are using something else is going to be very important so that you minimize confusion. And here I'd like to mention that at the IMF, we've done work on the integrated policy framework that has precisely helped central banks communicate better also in terms of when to do these interventions. So if you're intervening because there are disorderly market conditions and because of financial stability concerns that may be building up, then you explain that's why you're doing it for. You're not doing it because you're targeting a particular level of the exchange rate. Volatility in and of itself is not a problem unless you see it showing up in indicators of financial instability or market dysfunction. Because then you point to that and you can say, well, that's the reason I'm in the market right now, otherwise I don't do it. So that gives you clarity on how this works. And then the last point is, again, an issue that emerging markets deal with, and maybe advanced economies are going to have to worry about it more, is the kind of the overhang or the shadow of fiscal policy on monetary policy making, right? Which is very often the reason a country's currency is depreciating is because fiscal policy is not in line with where it should be. Or the reason that you are seeing risk premia go up on their bonds is because fiscal policy is out of line with good policy making. And while maybe central bank governors can't say that directly, I think as the IMF we can say this, which is it's absolutely critical and important in this period of volatility for fiscal policy to be supportive and doing the right thing to be able to stabilize the economy, as opposed to just having unsustainable buildup of debt, all of which central bankers can't deal with.
Dr. Rajan, it leads to another question about another tool that is in the toolbox, which is asset purchases. And given the fiscal challenges, some of the challenges from the central banking side of things, for using that tool to suppress some of the volatility?
Well, I think that's a place which is a little less, it's less clear, it's helpful. And I think it's more dangerous to assume that we can affect asset prices. I presume you're talking more than just bonds, but even bonds. There's a real question about whether you're confusing markets, and what you manage to make go up now may eventually have to adjust. And is that going to create more volatility down the line? I mean, clearly, we've had a lot of quantitative easing across the industrial world. It was perhaps not as confusing when these countries didn't have a fiscal problem. And you could argue this is based on market functioning, and maybe it has a monetary function also, though being clear about which one you were really doing was also very important, and I don't think central banks have been that clear sometimes. But what we're seeing increasingly is there's a fiscal issue in a number of countries. And for central banks to be supporting the sovereign debt at that point looks a lot like what we got away from in emerging markets, which is fiscal financing by the central bank. So I think you have to be very careful on that. You have to be even more careful when it's non-sovereign assets, when it comes to stocks and so on. I think then you really look like you're affecting market levels, and that could create a lot of uncertainty in markets. When are you going to come in? When are you going to leave? So I would say, by and large, let that be the realm of markets. And going back to the policy, use your interest rate tool as best as you can, and recognize if you are ever in a situation where you're at the zero lower bound, we've seen that these other tools, asset purchases, have modest effect. But more important, they create a problem for you down the line. How do we get out of this? How do we sell the assets on our balance sheet because the markets haven't gotten used to it? This is a huge issue for the Fed, which the central bank balance sheet being so big, reserves out there being so big. How do we get back to the old central bank balance sheet size? Probably not possible within the foreseeable future.
Dr. Gopinath, I'll give you the final word because we are running out of time. But I want to get a sense, just to sort of sum up in this sort of shock-prone world that you see us and have identified us as being in, what you see as the biggest challenges, the idea of maintaining independence, of being clear with communication, of communicating enough but not too much with the crocodiles. How you see this going forward?
Right. Firstly, I think we should recognize that many emerging market central banks have gotten really good at this and have been doing a great job in delivering stability to their economies. And so continuing on that path, which is strengthening your framework, strengthening the credibility of your framework, which is critical, and which is why central bank independence is critical, to have that, to continue building that credibility. Because when you are in an incredibly uncertain time, you can be sure that you are going to get some things wrong. But it has to be viewed that you got it wrong because of general economic uncertainty, not because this was politically motivated in one way or another. So continue to build that credibility is absolutely critical. And when it comes to FX intervention, and I'm going to stop with that, which is, again, when you're in very uncertain times, and given what we're seeing right now, which at this moment is not, I would not describe it as disorderly market conditions for most countries. Of course, for some they may be, but for most they're not. So I would say keep your powder dry, because when you're going to have more volatility, that may show up in the future. But at this point, it's prudent to keep your powder dry.